Have you ever heard words like index fund or ETF and felt confused? They sound complex, but the idea is simple. These are different ways people invest their money. Let us understand them like a simple story. Imagine a basket full of fruits. Each fruit is a different company. Buying the basket means owning many fruits at once. This idea helps reduce risk. Now, let us talk about index funds. An index fund follows a list of companies. This list is called an index. Think of it like following a class roll list. The fund buys all companies on that list. It does not try to pick winners. It just follows the list quietly. This makes index funds simple and calm. Many ordinary people like this style. It is slow and steady. Now let us talk about mutual funds. A mutual fund is also a basket, but someone actively manages this basket. That person chooses what to buy or sell. They try to do better than the market. Sometimes they succeed. Sometimes they do not. Mutual funds often cost more. This is because of active work. People pay for the manager's decisions. Now think about ETF means exchange traded fund. It is like a mix of a stock and a fund. You can buy or sell it. Anytime markets are open, ETFs can follow indexes too. Many ETFs are very low cost. They are flexible and simple. People like them for ease. Now comes hedge funds. Hedge funds are very different. They are usually for very rich people. They have strict rules to join. Hedge funds try many complex strategies. They aim to make money in all situations. They can also lose money. They are not for beginners. Most people never use hedge funds. So why do these choices matter? Because they affect risk and cost. They affect peace of mind. Index funds are calm and simple. They suit long-term thinking. Mutual funds add human decisions. That can help or hurt returns. ETFs add flexibility. They are easy to trade. Hedge funds add complexity. They are high risk and high cost. Ordinary people usually choose simple options. Simple options are easier to understand. Understanding reduces fear. Fear often leads to bad decisions. Good investing is about patience. It is not about fast money. Most people invest for the future, like education or retirement. Lower costs help more money grow. High costs eat into returns. That is why fees matter. Index funds usually have low fees. ETFs also often have low fees. Mutual funds usually cost more. Hedge funds cost the most. Time also plays a big role. Long time favors simple strategies. Short-term moves can be stressful. Many people want less stress. That is why simple funds are popular. Investing is a personal choice. What works for one may not work for all. But understanding options is important. It helps people choose wisely. These funds are just tools. Tools should match your needs. No tool is perfect. Each has pros and cons. Learning basics gives confidence. Confidence brings better decisions. Better decisions bring better outcomes. This applies to money and life. Complex words hide simple ideas. Once explained, fear fades. Index funds follow the market. Mutual funds try to beat it. ETFs trade. Isali, hedge funds take big risks. All are part of the same system. A system built by people. For people and businesses, understanding brings clarity. Clarity brings calm. And calm helps money grow slowly. Now let us continue the story and make everything even clearer. We will compare these funds using daily life examples. Imagine saving money every month from your pocket money. You want that money to grow safely over time. First, think again about index funds. Index funds move with the whole market. When the market grows, they grow tall. When the market falls, they fall as well. They do not try to be smart or fast. They just follow the crowd calmly. This makes them easy to trust. Many families choose them for long goals. Now think about mutual funds again. Mutual funds have a manager. The manager makes daily decisions. They try to choose better companies. Sometimes they choose well, sometimes they make mistakes. Their choices affect your money. That is why results can change. Mutual funds need more attention. People often check them often. This can create stress. Now let us look closer at ETFs trade like normal stocks. You can buy or sell them anytime. This gives more control. But it also tempts quick decisions. Some people like this flexibility. Others prefer calm investing. ETFs can follow indexes. They can also follow sectors, like health, energy, or tech. This lets people choose themes. Now think about hedge funds again. Hedge funds are very private. They use complex methods. They borrow money to invest more. This can increase gains, but it can also increase losses. Hedge funds aim for high returns. They also charge high fees. This reduces final profits. That is why they are not common. Most people never need hedge funds. So how do people choose? They think about time. They think about risk. They think about comfort. Someone young may take more risk. Someone older may want safety. Simple funds suit long journeys. Complex funds need deep knowledge. More knowledge means more responsibility. Less knowledge needs simpler tools. That is where index funds shine. They require less watching. They allow peaceful waiting. Peace matters in money decisions. Stress often leads to bad choices. ETFs sit in the middle. They are simple but flexible. They need some discipline. Without discipline, problems arise. Mutual funds need trust in managers. Trust is not always easy. Past success does not promise future success. This surprises many people. Costs also matter a lot. Lower cost means more savings. Higher cost eats growth slowly. This effect grows over time. Time is powerful in investing. Small differences become big later. That is why patience wins. Quick action often loses. Ordinary people want steady growth. They want sleep without worry. Simple plans help that goal. Understanding removes fear. Fear causes rushing. Rushing causes mistakes. Learning slows you down. Slowing down improves choices. All these funds are just tools. Tools must fit the user. There is no best fund for everyone. There is only what fits you. Money grows with discipline. Discipline grows with understanding. Understanding comes from simple ideas. Simple ideas build strong habits. Strong habits build strong futures. This is why learning matters. Funds are paths, not promises. Walking slowly avoids falls. Calm steps go far. That is the quiet lesson here. Choose clarity over complexity, and let time do the hard work.